Good afternoon and welcome to BizTech Asia's Midday Market Watch. I'm Jeffery Halley and it's Thursday, the 8th of February. Our guest today is Jessica Amir, market strategist at moomoo down in Sydney. Jessica, good afternoon.
Great to see you, Jeff.
Before we get into the interview, let's just have a look at the performance of markets around Asia today. Once again, a bit of a mixed bag. The Nikkei 225 in Japan is having a cracking day, up 2.26%. Shanghai is also recovering ahead of the Lunar New Year, up 1.05%, but Hong Kong has retreated by 0.88%. The S&P ASX 200 down in Sydney is up 0.3%, while South Korea's Kospi is up 0.21%. In Singapore, the Straits Times is down 0.33%, with Kuala Lumpur up 0.17%. Jessica, just briefly, what do you make of today's price action?
Well, there's a lot going on, but overall the trend is up. We're seeing most markets test new highs, which is good, or hovering around the vicinity of new highs. And that's basically on the back of the rhetoric that we are probably going to see some cuts come in from the Federal Reserve. Overnight, we heard from several Fed speakers, and I guess they're more or less pointing to cuts not necessarily coming quicker than expected, but that they are coming. And then second of all, we've got broad company earnings. That is much better than expected. And overnight, we had some good numbers out from Disney, Arm and SoftBank. And broadly, the S&P 500 is in striking distance of a key milestone, hitting 5,000 points. So optimism, broadly speaking, big picture, is quite high.
Right, so we saw more deflationary inflation data from China today, and negative headlines out of China seem to be a daily occurrence. The opposite seems to be the case in the US, as you've just alluded to. Record highs for stock markets, resilient consumer spending, fantastic non-farm payroll numbers the other day, a Fed in the meantime remaining hawkishly unchanged. It seems to be a story of two halves here, two contrasting halves. But is that really the case with the United States at the moment?
Yeah, it is a tale of two halves. But I think we have to remember that the Asian economy, more specifically China, is going into Lunar New Year holiday. And we were recently in China, and it doesn't really necessarily seem to be all doom and gloom. So we were out on the streets and we could see construction was indeed picking up, and there was a lot of people spending. So a lot of the data that we're getting out is lagging. And so post-Lunar New Year, you might be expecting activity to pick up. Probably will take some time, and you might probably see some more stimulus come through. So I think it'd be remiss if we didn't see that stimulus come through. Increasingly, we're seeing a lot more support go into the financial sector of the Chinese economy. And then on the flip side, of course, activity does pick up on the ground in China post-Lunar New Year. And that'll in part, also support commodity prices to move higher. But then if we think about the US, I guess we're seeing a lot more layoffs. So I guess layoffs are the theme of the week. So we've seen layoffs, I guess, at a peak now, and company layoffs in the US have reached a year high, and I'm thinking that they're probably going to continue to rise, and that's because we're not really through reporting season yet. Of course, there's a lot more companies to announce, and the pressure really isn't going away from companies who are really suffering the lagging effects of interest rates, while their key customers, the consumer, are suffering also because of interest rates and, of course, higher food prices, electricity, and insurance costs as well.
Okay, so what you're trying to say is that the outlook for the US consumer on the ground then isn't quite as rosy as the data would suggest?
Yeah, absolutely. And we're seeing that in the credit card data. So overnight, we got some data out of the US, and credit card the credit card, I guess, total, if you will, has hit an all-time record high of $1.13 trillion. So that's absolutely outstanding, and a big part of that, what has contributed to the rise, are millennials, and increasingly we're seeing a lot of millennials, I guess, not make their payments. So we've seen delinquencies actually increase. So this is a bit of a concern. And I guess overall, what is also alarming is that our credit cards actually rose by, credit cards increased by $50 billion in the last quarter of the year. So obviously this is telling us the consumer is feeling some pain. And of course, that's why the Federal Reserve is more inclined to cut interest rates. And the futures are saying that they'll indeed do that, Jeff, in May. Less likely in March, but if they do cut in March, I guess that would be good and in line with the Taylor rule. But more or less, of course, the Federal Reserve is looking to cut because the consumer is feeling a pinch, and that's being reflected in the job cuts as well as the credit card data that's come out overnight.
Right. So if we're looking at the US consumer, and if your base case is things aren't quite as rosy in that particular segment, and for our viewers, US domestic consumption is by far the largest component of US GDP, not exports. What stocks then should investors or could investors be looking at to hedge themselves against the risk of a consumer slowdown in the United States?
It's a great question. So I guess there's two approaches. So the first thing would be to take a typical hedging approach. So we know the Federal Reserve is about to embark on an interest rate cutting cycle. And would you believe that gold actually rallies in an interest rate cutting cycle? In fact, the last 3 times the Federal Reserve has cut interest rates, we saw gold rally up to new highs, new all-time highs to be precise, new all-time highs that they were at the time. So in fact, if we go back to 2019, when we saw the Federal Reserve last cut rates, gold rallied up in the order of 41% to a new high. So the first thing that you should probably consider is getting some gold exposure. We know down under today in the Asia Pacific region, we are seeing some gold stocks indiscriminately be sold down, and we're seeing some gold stocks hit new 52-week lows. So it might be an opportunity to potentially look at some of those gold stocks that are discounted, and we know that there is probably likely upside ahead. So that's one way that you can think about to get some upside in your portfolio right now. But second of all, we spoke about credit cards hitting a record all-time high, that $1.1 trillion absolute cracker of a credit card blowout. So obviously credit card companies are benefiting. We know the consumer's feeling a lot of pain, but look at credit card companies in the US, Visa, MasterCard, and Amex. And all 3 of those companies, would you believe, are trading at absolute record all-time highs. And that's obviously because their revenue and earnings are rising, while I guess more of us go out and continue to splurge on credit cards. We know it's Valentine's Day next week, and obviously you being one of those key people who are going to be running out to the shops to spend on your loved one, obviously that's by the by. Why we're going to see a credit card use increase. So I guess it'll be a potential opportunity for you to, I guess, explore some upside to your portfolio if you did want to add credit cards to the mix.
I'll tell my wife that because it's actually my birthday on Valentine's Day, so it tends to be a two-way street.
Double whammy. Amazing.
There we go. Jessica, thanks so much for joining us today. As ever, it's been a total pleasure.
Thank you. Great to see you.
We've been speaking to Jessica Amir, market strategist at moomoo, on BizTech's Asian Midday Market Watch. We'll be taking a break for the next 2 days, Friday and Monday for the Lunar New Year, but we'll be back on Tuesday the 13th. I'm Jeffery Halley, and this video and podcast, will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it with our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in.